I have been noticing many of those growth stocks have started to stabilize. They kind of make some bullish moves to the upside. Stocks like Shopify, stocks like CrowdStrike, even some stocks like, DocuSign pretty recently, and a couple of other of those type of growth stocks that are down 50, 60, 70, 80, even 90%. And eventually these growth stocks are eventually going to become a buy, where there's some price where we are willing, to pay for them. And this is a stock that I actually did a video on before, but I decided to do another video, and it's Shopify, and it's down over 76% of its highs. And as you could see, the chart again is starting to get a little bit bullish. It's been straight down on the company, and now it's making higher highs and higher lows. And again, the chart looks, pretty bullish. So maybe, stocks like CrowdStrike and Shopify, maybe they have, found a bottom after being down 76%, and maybe they are, cheap enough for us to actually open a position in such companies. So this is what I'm going to review in today's video. And again, I hope you enjoy it. Now, most of you are familiar with Shopify, so I'm not going to go over, what Shopify is, but they have a 10% US e-commerce, market share. They operate in over 175 countries, over 561 million, unique online shoppers for 2022. Its revenue 5.6 billion, and I'm sure most of you are familiar with the company. But this is the problems with Shopify. Shopify has been trying to become vertically integrated, which is something that's pretty good for the long term. They are trying to build their own ecosystem of other things where they can, for example, like Shopify Capital. Shopify Capital actually funds, those type of businesses that are trying to sell on Shopify. And it's like a lending type of platform. And it actually has been growing amazingly well. They even invest in some of those businesses. And they have something else called, Shopify Tax. They have Shopify Pay, Shop Pay. And they have all kind of, different apps and different things that they are trying to become vertically integrated. And this is pretty amazing. They also have something called, a Shopify Logistics, which this is where I have the problem with. But again, Shopify Logistics, they pretty much take care of everything within their own, ecosystem for the people that sell on Shopify. But this is where the margins of the company have started to go down, because their revenue comes from two different sources. The first one is a subscription solutions, which is my favorite with Shopify because it's much higher margin, it's more recurring. I really like their subscription solutions, and this is what they were focused on before. But then they went on merchant solutions, which has something to do, with Shopify Logistics and a couple of other things. And as you can see, for example, they made pretty close to 1.3 billion in merchant solutions revenue, but out of 1.3 billion, they spent $850 million in, a cost of revenues, which is a much lower margins than whenever they made 400 million from subscription, and they only spent 85 million. And especially last in 2021, when they made 350 million, they only spent 75 million. So their margins on the subscription solutions are much, much higher than their merchant, solutions. But I get what Shopify is trying to do. It's trying to become a one-stop shop, a vertically integrated platform where it's pretty hard for you to move away from Shopify if you are actually selling on Shopify. But even with all the growth this company experienced and with everything it has, with the market share it has, it's still losing money from operations. And the main reason it's losing money from operations is they are spending a lot of money on sales and marketing, which I'm going to go over in a little bit, but they are spending again a lot on research and development, more than doubled the research and development and trying to get out of platforms like Shopify Tax, Shop Pay, and all those type of things. And again, this might be amazingly well, but we have to ask ourselves, why is Shopify spending all this money on marketing, on research and development, and all those type of things if it's such in a dominant place and a dominant market share? And in my opinion, Shopify is doing that because there's a lot of other competition in the United States. And this is a pretty cool website which is actually updated monthly, and it gives you the e-commerce usage description for the United States. And you can see Shopify is the dominant one with over a 25% market share. But you also have Wix, which Wix has been also, massively growing, and it's around a 24% market share. You have others, you have some Squarespace and all those type of different platforms. But again, there's a lot of competition on Shopify, and maybe this is why Shopify is spending so much on marketing, and this is why Shopify is spending so much on research and development. Now, the question is that, Shopify is not profitable because it's spending so much on marketing and stuff. Well, do they actually have the power to pull back on the marketing and for them, to become profitable? Maybe they can. But again, will they grow revenue as much as they have been actually growing? This is, my point. Whenever you have a company that spends a lot on research and development and sales and marketing and is actually losing money, you have to ask yourself, how are they going to make money? If they can make money maybe by scaling back the marketing in the future, but maybe if they scale back, competition is going to win market share over Shopify. So maybe they cannot scale back. So Shopify really doesn't have, some type of a clear plan to become profitable. This is my main point. It's an amazing company. It's growing revenue fast and all that type of stuff, all the sexy stuff, but it's not making money. Why is it not making money? Again, because of all the research and development and sales and marketing. Well, if they cannot cut back on those type of things, and if they cut back, it's going to slow down their growth. That means Shopify, doesn't have some type of a, moat or some type of a competitive advantage over Wix or over any of those other, websites, which Wix actually has been growing faster than Shopify in terms of market share, in the United States, which again would tell you that maybe Shopify, will take a long time for it to actually become profitable. This is one of the problems I have with the company. I'm talking about the problems in this video because most other people, again, they talk about the bullish case. So I'm trying to find, what is wrong with this company and make sure we are not overpaying for, Shopify. But looking a little bit more at some other things which I don't like, and this is the stock-based, compensation. And this is a big problem with these type of tech companies and internet companies. They claim to be, free cash flow positive, and they try to brag being, free cash flow positive in some of those companies. But again, it's because of their stock-based compensation, which is massive. And a lot of people actually, ignore the stock-based compensation. And this is, pretty massive growth for the company, even though the share price went down over 75% from its peak. Even though, things have slowed down a bit, it's still growing like never before. And this is something that's not good, for the company. And if you look at the shares outstanding, because it comes out of the shares outstanding have been growing pretty much every single year except 2022. Maybe I believe they did some type of a share repurchase program. But again, shares outstanding haven't gone, down that much. So you as a shareholder, you didn't benefit as much as you really thought if they ever did a buyback or whatever they did. I haven't really followed along what they did in 2022. But we can see their massive problem with stock-based compensation and how their shares outstanding have been going up since 2016. And if this actually continues, even though things slow down a bit, if Shopify doesn't slow down their stock-based compensation, I believe this is a big problem on profitability, and it's a big problem for shareholders. Now, looking at some of the positive stuff with Shopify, it has one of the best, balance sheet you could pretty much ever have. They have around $6 billion in current assets, and all their debt doesn't even amount to $1.6 billion. So again, this is one of the best, companies, you could dream of, and they have a lot of marketable securities, which is why they showed a profit before, because they had gains on marketable securities, but the business itself from operation was pretty much never profitable. They had 1 or 2 quarters of, some pretty decent profits, but it has not shown itself to be sustainably profitable, or at least getting better, or at least having a plan for it to become profitable. I haven't seen that from Shopify yet. So taking a look at the analyst estimates, and I believe this is the best way to value this company. Now, I try to do many other valuation models. I try to do my own estimates on the company, using 10-15% revenue growth, but nothing pretty much added up. But the analysts are expecting something totally different than what I have. And in my opinion, their estimates are more on the higher side for Shopify. They are actually expecting a 21% compounded of revenue growth from 2022 to 2027. They are expecting a massive growth in net income. They're expecting net income margin to go up to 9% of revenues by 2027. Now, this to me doesn't look like some type of a safe scenario or some type of a worst case scenario. In my opinion, this is the best case scenario for Shopify. Unless you want to bet on Shopify growing revenues 35% again. And again, this is not something I want to bet on. So if we just use the analyst estimates, and if we look at what type of revenue growth Shopify will actually have, is pretty close to 23% and 23.5% on average, which is again not bad at all. So for my valuation model, I'm going to use double their revenue growth, which is around 50 times earnings. Although 50 times earnings, in my opinion, is very expensive, but I'm doing it to illustrate a point. So if we use this very bullish net income expectations for 2027 by the analyst, and we time it by 50 times earnings, this is only a $68 billion market cap. The current market cap is $58 billion. So there's not even 10 or 15% upside. So for me to double my money in Shopify, if I want to buy it right now, I have to bet on Shopify trading at 100 times earnings in 2027. And this is, again, not something I really, want to bet on, which is why I'm personally not buying Shopify at such prices. Now, that doesn't mean, Shopify stock can't go up. The stock has always, been expensive, but I believe it was an amazing buy, pretty close to $21 to $25 per share. Again, the chart is bullish on the company. Maybe the stock has bottomed, so I have no idea where it's going next. But what I can say is that from me doing a pretty basic valuation model on Shopify, and if they just achieve those numbers, if they don't exceed them, which I believe they won't, again, Shopify to me, it's still expensive despite the stock going down, 76%. Now, if it does go below $30 per share, in my opinion, that's a pretty good speculative bet to have in someone's portfolio. But as such, prices, again, maybe the stock can go up because, it looks like it bottomed. Maybe it did. But again, I can't predict the stock price, but I believe Shopify is still, expensive at such prices. So this was my assessment on Shopify stock. I hope you enjoyed this video. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.